Sandeep, I've made you the host. I think we're going live in another 30 seconds.
That's good.
Sandeep, I've made you the host. I think we're going live in another 30 seconds.
That's good.
Okay, perfect. So we're live. Welcome, everybody. Thanks for joining us on an evening during the weekday. It's my pleasure to invite Mr. Sandeep Tyagi, who's the founder and CEO of ST as well as Gulak, to be here and take us through an insightful session. Welcome, Sandeep.
Thank you so much, Isha. It's great to always connect with our investors and people who are interested in learning about finance.
Great. Thanks, Sandeep. Well, a little bit for everyone about Sandeep. I think you would have seen him on other platforms also taking talks and discussions, but he has 30 plus years of experience in portfolio management, analytics, and consulting. And he's an alumnus of IIT Delhi and MBA from Columbia Business School. Talking about ST and Gulak, our brands, for people who are new to this platform, ST is a quantitative management firm which was founded in 2008 when SEBI permitted algorithmic trading in India. In ST, over the last 15 years, we've developed leading investing and broking products using analytics and computer science. We have our in-house portfolio management service catering to high net worth individuals, and we operate out of 8 countries and have around 1,000 crores of AUM with us. Now, a couple of years back, we felt why not offer our expertise to the retail investors in India as well. And that is how Gulak was born. So Gulak is the retail investment advisory arm of ST, which uses the same sophisticated algorithmic quantitative algorithms that are used by ST to serve its institutional clients. And using those same models, we built portfolios for retail investors, which are available on Smallcase and PickRight, as a lot of you would already know. We have served over 6,500 paid subscribers till date from last year onwards, and our strategy is focused on multi-factor models. Now, as regards today's webinar, we are here to talk about how you can analyze and understand your investment plan better. Because as you would know, a lot of you would rely on returns to understand the health of your investment plan. But are there other parameters, other factors of your portfolio that you need to be cognizant of to really understand if your portfolio is doing as well? So to give you more insights on this topic, we have Sandeep who will take you through the presentation. And please feel free to ask questions during the webinar. We'll be free to take as many questions as possible today. So over to you, Sandeep.
Thank you, Isha. I'm going to start sharing a screen. I hope you guys can see it. What should be saying is how to measure investment performance and think about whether one alternative is better than the other one. How do we do that? So let's get into this. I think most people, as you said as well, focus on did they make profit or did they make a loss? So the biggest indicator of whether they've invested well or not is how much money are they making? What is the return? And that's really important because that's why we invest, to get returns on our investment. But is that the only thing one should be looking at? Clearly, there is more to it than just the return. So to understand this better, let's start with an example. Let's say you have 2 funds. One fund has returned 8.1% and the other fund has returned 12.2%. Which fund would you prefer to invest? Looking at only returns, I guess a lot of us would say, hey, fund B is much better. It is 4% more return, so I would do that. But just going by the looks is the same as just trying to find a spouse with only looks. Beauty is important, returns are important, but there are many other important characteristics that you have to pay attention to. What are those characteristics? Well, they pertain to risk. So return and risk go hand in hand. There are no returns in the market without taking some type of risk. Some investments have low risks, other investments have high risk. And when you get some return, you have to also know what risk you were taking to judge whether that return was good or not. So how do we do that? First, let's understand, how do we measure risk? There are two big ways in which people measure risk. One is called maximum drawdown, which is what is the maximum amount of money you can lose by investing in something. And the second is called standard deviation. Now, that is a mathematical term. What it means is, how much does the return vary? So if you were to, let's say, look at weather, you can say, in summer, on average in Delhi, the temperature is, 40 degrees centigrade. But how much does it vary day to day? Some days it's 36, some days it's 44. So the variation is, let's say, 4 degrees on average. But there could be a completely different geography where the average temperature was, let's say, 30, but some days in desert, for example, if you were to go into Rajasthan, the average temperature may be 35, but it could go up to 50, or at night it could be really cold at 20. So the variation is much more. So the concept of standard deviation really measures how much can something vary. How is this applicable to return? Well, in returns also, how much something varies is a very important concept. Because if you are investing in, let's say, fixed deposit in a bank and you made 8%, you're going to make 8% no matter what. So there is no variation. There is no up or down. You won't make 7%. You won't make 9%. You'll always make 8%. But if you invested in stock markets, you may make 20%, even 30%, or you may actually end up losing some money. So does it mean that FD is better than stock market return? Because in some years, stock market will give negative return and fixed deposit will give 8%. In other years, stock market may give 30% and fixed deposit may give 8%. So which one is better? Now, variation is the measure by which you try to figure that out. So how do we use it? Let's take the example that we had and go a little deeper. Fund A, let's say over 5 years, had this profile. It made 10.2, then 6, 5.8, 6.7, 11.6. So the average comes out to 8.1. Fund B, on the other hand, did 18.7, 6.1, 5.4, 8.0, 22.9. The average comes out to 12.2. Now, same numbers that I had told you, but you have a little bit more detail now. What to do with this detail? So when you calculate standard deviation, and again, that's a mathematical concept, you can calculate it by using Excel or a calculator or something like that. But, on average, it means how much does it vary from year to year? The standard deviation for Fund A is 2.4%, whereas for Fund B is 7.2%. So standard deviation is 3 times for Fund B than it is for Fund A. Now, when you take these two numbers and you divide the average return by standard deviation, you get something that's called information ratio. So for Fund A, the information ratio is 3.4, and for Fund B, it is 1.7. That's simply 8.1 divided by 2.4 or 12.7 divided by 7.2. That's the number and the calculation we are doing. Now, this gives you a very interesting understanding of what is the return relative to how much it varies. Why is this important? Because the variation tells you that the 8.1 number can be 2.4% lower or 2.4% higher very easily. Similarly, 12.2 number could be 7.2% lower or 7.2% higher, again, very easily. So 7.2% lower means you only get 5%. And 7.2% higher means you get 19.4%. So there is variation going on, and the ratio of the two tells you how to combine the return and risk together in a single number to get a better sense. Now, when you look at information ratio, on average, this would say fund A is a better investment risk for return than fund B is. But that doesn't mean that you're only going to invest in fund A because fund A has lower return. So how to think about that a little further? Now, if I take, now we're getting into a little bit more graphs and mathematics, but it is important to understand when we look at fund A, the variation is less. So the average is somewhere in the middle at 8%. And the variation in the low and the high is much less than the orange line. The orange line, the average is at about 12%, but the variation is more. So you can, in theory, in 1% chance, lose money, but you will also gain money. Now, where do these things cross over? So at about 18%, that means about 1/5 of the time investing in fund A would be better, and 4/5 of the time investing in fund B will be better. So now you have to decide what is your risk tolerance. If you're type of the person who wants 100% surety that I don't make less money than what I could in some other scenario, then the only choice for you is fund A. So in this case, you will never lose money. You will never have the risk of losing money or having a very low return. But you're also not going to make a very high return. So you are, if very risk averse person, you'd go for fund A. If you are a moderate risk person, you say, yeah, I know 18% chance that I may not make as much money if I had put it in fund A, but 82% chance that I'll do better, and I'm okay taking that risk. Then fund B is better choice for you. So this is how you combine risk and return and get a better sense of what investment portfolio is better for you. Now, this also is important when you're comparing funds, because many times people compare a fund A and fund B, and they say, oh, this fund this year made less money, the manager is no good, or the fund is no good compared to another fund. Just like we compared fund A and B in the last slide, a better returning fund, which will do better 80% of the time, can make less money than fund A 18% of the time. So if the fund is taking more risk, it has some chance that is going to underperform the other market. Now, what am I showing here? We all know about Warren Buffett. We have all seen his videos, and of course, he's a legendary investor. But even in Warren Buffett's portfolio in 1973, he lost 48.7%. There have been 10 years over his very long career now, almost nearly 50, 60 years of investing career, in which he has made losses. So it's not like somebody, even as legendary as Warren Buffett, will always make profit or will not lose a lot of money. Why? Because he invests in equities. If you invest in equities in stock market, there is going to be stock market risk. And no matter how good you are, you will have variation. Sometimes you'll lose money, sometimes you'll make less money, but on average, you'll make more money than investing in the bank, which he has shown over 50, 60 years. So because of the type of risk Warren Buffett is taking, he's investing in US companies. His benchmark should be S&P 500 because he's investing mostly in US companies. When compared to the benchmark over the period of investment, 1965 to 2021, which is 56 years, he has produced a return of 20.1%, whereas S&P has produced a return of 10.5%. So even though there are many years where he lost money, there are many years where he probably underperformed even S&P 500, in aggregate, he has done much better than his benchmark. This shows that he has the skill to be a good investor. So just producing higher return in 1 year does not give you the ability to say whether one product is better than the other product or not. So you must compare against the right benchmark and over the right time period. So if you're taking a specific risk, you have to compare it to the benchmark of that risk. If you're investing in stock market, compare it to Nifty or BSE 500 or some index of stock market. If you're comparing it to fixed income, then compare it to fixed deposit rate. RBI's website has that. They publish a regular rate. So compare whether your returns are comparable or better than that or not. If you're investing in a technology sector, then compare it to technology sector returns, not to Nifty, because Nifty has all the sectors. It has utility stocks, oil, energy, healthcare, everything. Sometimes people invest in technology stocks and feel very good because particularly in US, technology stocks have done extremely well over the last 10-20 years. But when you compare your investment to technology sector return, then you can say, are you a good investor or not, relative to what risks you are taking. Similarly, the higher the volatility. So if you're investing in stock market, for you to know what your return is, you need a longer period. You need 3 to 5 years over which you need to average returns, then measure it against benchmark to know with some surety whether one product or manager is better than the other product or manager. On a day-to-day basis, if you are investing in a volatile asset like stock market, you will underperform and overperform regularly. So you'll say, oh, this guy is good, this guy is bad. You remember that joke where they say, you ask somebody, is my indicator light working? They look out the side of the window and say, it's working. No, it's not working. It's working because the light is going off, on, off, on. Same thing with performance. If you decide this on a daily basis, you say, hey, my fund manager is good. Then tomorrow, oh, my fund manager is horrible. But if they're investing in equities, that's not the right way for you to figure out whether they are good or not. Now, the other aspect is when we combine this with a behavioral bias of recency, it makes things even more complicated. So even if you have 5 years of history and you know somebody has been performing well and you invest in the fund and the fund loses money in the next month, or you are going to immediately try to run away. Why? Because it's your personal experience and it is recent experience. I'll give you an example. Let's say you read some restaurant's review on Swiggy or Zomato or whatever else, and it has thousands of 5-star reviews. You go to the restaurant, but somehow that day the waiter you get is not very good. They mix up your order, the dish is not great, and your personal experience is bad. Now, based on that, you're very unlikely to go back and try that restaurant, even though thousands of people have had 5-star experience there. But your experience and the most recent thing weighs very heavily in your head. Same thing happens with fund investment. Even though there may be 5-10 years of track record of what people have done and how well they have invested, but when you invest, if in the first 15 days, 30 days, whatever it is, the investment returns are not as good as some other alternatives, it's very easy for you to get disenchanted with it and say, I got to run away and change. Not a good strategy. You need to do your homework properly over the right period of time evaluation. And once you have done it, you've got to stick with your investment decision. That's what makes it a good investment strategy. Otherwise, you're always chasing performance and it always is one step ahead of you. Oh, this fund didn't do well, I'm going to move to this fund, which did well in the last month. While now this fund has not done well, I'm going to move to the third fund. Example I'm giving here, we get this question all the time. Gold has done very well over the last 10 years. Why shouldn't we invest in gold? Because we have much longer history of gold performance. So if you look at 100 years, gold has underperformed equities by significant amount. Even though on any rolling 10-year period basis, there is a 43% chance that gold will outperform equities. So it's close. but not over all the knowledge that we have about how gold and equities work over periods of time. So the more information you have, you need to rely on that information to make your decisions, not rely just on most recent and your personal experience. Those are the important aspects in how you get to determine how to measure performance in an investment product. Now, what is the impact of doing all this? And say, look, I do all of this, what will happen? And I just wanted to leave you with this power of compounding. If you invest in fixed deposit, or if you do a lot of chasing and your, let's say, return is 8% versus you did a systematic investment and your return was 12%, which is, roughly the numbers I would expect people to achieve at the two spectrums. Then over 40 years, the returns are 21 versus 93. That is more than 4 times the money. So you may end up with more than 4 times the money over 40 years simply by having 4% difference in your performance year on year on average. So compounding makes a huge difference on how your performance is going to be over your lifetime of savings. That's pretty much it. Here is a famous saying that it is possible to make a lot of money in stock market, but it cannot be done overnight and it cannot be done by jumping around. Big profits accrue to people who are intelligent, careful, and patient investors, and not reckless, overeager investors. That's pretty much it. These are our disclaimers. This is always subject to market risk, and we provide this to educate people, but not directly. You need to understand the risk of all the products you're investing in.
Right.
Isha, I'm sure there are a bunch of questions, so I'll stop here.
Yeah, definitely, Sandeep. Thanks a lot for sharing the presentation. I think there are a few questions about what you mentioned and also otherwise about Gulak portfolios. So firstly, like you said, of course, I've also heard this saying that Warren Buffett had said that, investing is simple but not easy. So the approach to follow is simple. Everyone knows you need to stay invested for the long term, but we tend to give in to our, day-to-day insights or apprehensions as to what is happening, and we pull out money from the stock market. So a lot of people would know what is the right thing to do. So it's simple, but following it is difficult. It's not easy. So thank you so much. Firstly, of course, Ajay Kumar is saying very insightful. Thank you very much for the session. Thanks, Ajay. We have Sajid Chauhan asking, what's the difference between information ratio, Sortino ratio, and Sharpe ratio? If you would want to take that.
Yeah. So information ratio is primarily concerned only with return and risk. Sharpe ratio goes one step further and it says what is the active return that you have, which means you subtract out the risk-free return in the market from the return of your investment and then measure and compare it to the variability of the return that you have been able to achieve. Sortino is another variant which focuses on positive and negative returns separately. Now, these are, I don't want to necessarily go into formulas because that's probably a little harder to explain just in video, but of course, a lot of material is available online. So they give you 3 different variations. Simplest is information ratio because it's simply measuring return and risk. Sharpe, one level more, it is excess return over fixed risk-free return and its variability. And Sortino is measuring the variability on the positive side is different than variability on the negative side, and they separate the two up.
Perfect. Thanks, Sandeep. I hope, Sajid, you got your answer. We have Nirmal saying, I think he's making a statement. He's saying, I'm holding cash for last 1 year, waiting for correction in the market. So you have any comments on that, Sandeep?
Yes, this is a very common question. A lot of people try to time the market. I'm sure you ever have heard the famous saying, what is important is not timing the market, but time in the market. Right. What does that mean? That means that it's very difficult to predict when the stock markets are overvalued, when they're undervalued. Many a times, if you were looking at stocks like Google or Tesla or even, all the tech stocks. Amazon, famously, Amazon was a loss-making company, but overvalued significantly in way back in year 2000. And people always were wondering what is going to happen, when the correction will come. And it came many times. But people who bought and kept on buying and holding good securities, they make very, very good returns. So staying in cash, and I hope you're not just in cash, you're in fixed deposit, you're going to make on average 8% or somewhere around that number. Staying in stock market, whether overvalued or undervalued, over long periods of time, again, over your lifetime of saving, you're going to make more than 12%. So that difference will always be there. Now, the choice is yours, whether you are going to try to get it precisely right or you are going to make it on average right. We have done some analysis, and in other webinars, we have talked about if you were very lucky and you got every month, you got exactly the right date on which you invested versus you did a monthly SIP. The difference is small over a lifetime of investment. So it does not matter if you are getting it exactly right or not. I would encourage everyone to think about whatever your savings are, get your proper asset allocation done. That's step one. Once your asset allocation is there, keep investing as you get savings. Don't wait. And then rebalance. If one asset has done, stock market has gone up 50%, sell some, put it into fixed income. If your stock market has dropped 40%, take some fixed income, put it into stock market, even though it is down, which is opposite of what people do. So asset allocation, regular investment, and rebalancing. That's the 3-step method.
Thanks, Sandeep. And I think having that view for the long term, because in the short term, we could have years where the market crashes and we won't get the 12% on average. So you'll have to look at it from a longer term perspective.
Yes.
Okay, so a couple of questions on PMS. I'll just club 2 questions together. Raj Sangvi says, can we please have Gulak Gear 6 in PMS form? Want to invest PMS sized investment, hence Smallcase would not be the right platform considering slippage cost. And then Anuj Rathi says, would you suggest someone to move to STPMS from Gulak portfolio if 50 lakhs threshold is available? So just a little bit of difference and which investor is more suitable to invest in which product.
Yes. So we would absolutely encourage people to move. We do have a product which is very similar. It's called Long Alpha in our PMS, which is available to investors who can make 50 lakh or more of investment. It makes the exact same process of investment and model. Now, if you look at the track record, you will see that Gulak 6 has performed better over last about 18 months than our Long Alpha product. So you would say, well, why are you asking me to invest in a product with more money, which has done less than Gulak 6 returns? And the reason is very simple. It's the exact same thing that I took you through. Gulak Gear 6 is a concentrated portfolio. It only invests in about 20 names at a time. The reason we do that is because we want to make it available to people who can invest 50,000 or small amounts compared to PMS, which is 50 lakhs. So if you want to be able to invest 50,000, we cannot give you a portfolio with 100 names because you won't be able to build that portfolio with 50,000 rupees. So PMS gives you a diversified portfolio. It carries position in almost 70 to 100 names against Gulak Gear 6, which carries position in about 20 names. Now, it so happens over this 18-month period or 2-year period even, Gulak Gear 6 has done very well because it has been concentrated, and with that concentration and good performance, its outperformance has been higher. But we believe over long periods of time, the PMS portfolio will do better. It will have lower volatility. It will have better performance because it's more diversified. So certainly we would recommend that if you have 50 lakhs or more, that you invest in that. The added benefit is you don't have the operational headache. Unfortunately, in the Smallcase implementation, we cannot execute for you. We can just give you the model portfolio. You have to then do the rebalancing, make sure that it is happening at the right time. If there are any issues, amount of money available, all of that has to be handled by you. In PMS, we take care of all of that. So that makes it a little easier for our investors. But that structure is available for the minimum investment that you just mentioned.
Perfect. Thanks, Sandeep. Then Anubrat is asking, if the markets are bearish, do the Gulak funds also move out of equity and hold in cash or liquid Bs until the market trends change? And how do we look at this entire
We've done a lot of research, again, to time the markets, and we've found, honestly, limited success. So how would you measure whether you have an ability to do this or not? The way to measure would be, you would set a benchmark and say, okay, I'm going to measure my performance over, say, 20 years. What if I kept a portfolio of 60% equities, 40% fixed income, and compared it to my ability to say, now I'm going to have more in equity, now I'm going to have less in equity. And what we found was that we cannot really find a systematic way of doing that very well. We do a little bit of it. We have done measurements over 18 macro factors, including things like interest rate, inflation, currencies, oil prices, gold prices, and so on and so forth, and as well as performance within the stock market to do this determination. But again, we don't do that today. What we suggest is that you set right allocation for yourself. So we have gear 1 to 6, which moves from 100% fixed income to 100% equities, depending on your life stage and your financial resources relative to the goals you have. You should pick the right allocation. And I've talked about this many times. The right allocation means the mix between fixed income and stock market investment. So gear 6 is 100% equities, gear 5 is 80% equities, 20% fixed income, and so on and so forth. So if you're in the right gear for investment, then you don't need to worry, because it'll automatically keep adjusting what it needs to do. The only thing you need to do is rebalance, as I mentioned. When stock markets do very well, you sell them a little bit, bring them back to 80% and buy more fixed income, and vice versa. If you're doing that, you don't need to do much more than that. At least we haven't been able to figure out systematically a way of measurably impacting our returns by timing the market.
So, Sandeep, just a question from me on this. We are saying that if you're invested in Gulak Gear 6, we should invest only if you're an aggressive investor, because then if the market, because markets can be volatile and like it's going very high up, it can go very high down as well. We will be okay with it, but we need to take a risk survey, and we not necessarily need to be moving to cash if we are an aggressive investor. So even if we are in stock markets, it could still benefit us in some way or the other in the long term.
Absolutely. And what happens is, investors are obviously not just using Gulak products. They may have fixed deposits in their bank. Let's say they have a fixed deposit for 20 lakhs in HDFC, and then they have put in, I don't know, 10 lakhs in a Gulak Gear 6. So they have two different investments, and they themselves, they may think they're aggressive, but really what is happening is 20 lakh in fixed income, 10 lakh in equities. So they are a 66-33 investor. They are Gear 4 investor. If they were investing only using Gulak products, they would be in Gulak Gear 4. But because they're using HDFC for fixed income and Gulak for this, they are doing fixed deposit here and equities here. That's okay. If you're doing that and the markets have really performed very well, like they have done for last 6 months, you can rebalance and you can say, my Gulak portfolio has gone up from 10 lakhs to now 14 lakhs. So I'm going to sell 4 lakhs of it and buy, I'll sell maybe 2.5, 3 lakhs of it and buy more fixed deposit in HDFC so that they are balanced again. Because you have to keep the balance in your portfolio. So that's how I would do it, not by going totally in cash or reducing it. It is moving and rebalancing to keep your fixed income and equity investments in the same ratio that you need.
Understood. So it's again to re-emphasize, we should take the risk survey and invest accordingly, because I myself might not be an aggressive investor, but I'm very keen on investing in Gear 6, and that's what I've done. So it's very important to then have a fixed income source, probably 10%, 20% based on my risk appetite, and keep adjusting it. So
Yes.
Anubhav, I hope it answers your question.
And our risk survey is available on Gulak website. So
Yeah.
you can just go there and take the risk survey. It'll tell you where you should be. And then when you look at your risk, you have to combine whatever else you are investing in. Both on equity side, you may have other stocks as well, or you may have other mutual funds. So you have to combine all of them to get the right ratio.
Right. Okay, sounds good. SK is asking, how can 60 to 70 stocks generate desired alpha? I think this is in relation to the PMS answer that we just gave.
Yes. Look, it's very, very difficult to predict exactly when a stock will continue to do well versus not. So we look at a universe of 500 stocks. Out of those 500 top stocks in India, which is the NSE 500 or BSE 500 universe, we score everything. And then because you're trying to perform like the market or better than market, what does that mean? If I were to perform like the market, I'll actually have position in all 500 stocks, because you don't know which one is going to perform or not. And when you look at the market return, what is called the market return, it will have returns from all 500 stocks. So if you wanted to perform like the market, you will have 500 positions. Now, what we do is we take that and we put all the factors that we have and we select which ones are going to be strong performers. So we do a strong performer analysis, and that narrows it down. Now you can narrow it down as much as you want. We all obviously have a view that this is the single strongest portfolio stock that we should do. What that does is it increases the volatility a lot. Now it is in aggregate, we know mathematically that this single stock has the highest chance of performing well, but it's still a chance. It is also possible that that stock has some problem, some news comes out, some issue comes out, and it doesn't perform well. So are we willing to take that much risk? We are not. So we don't put all our money in one stock. We start expanding. Now for Gulak Gear 6, it's 20. For PMS, it's 70. If we had an investor who wanted to be even more conservative, they wanted lesser variability to index, this is called tracking error, then we would have even 250 names in the portfolio. So it depends on how much tracking error do you want relative to index. If you want to perform at least closely to index as much as possible, then you will need to keep increasing the number of names in your portfolio.
So, Sandeep, does that mean that a PMS portfolio, according to us, is more suitable not for an extremely aggressive investor? Because we are, or is it that because the investment ticket size is so huge, anyway, the person should not be aggressive as per us?
No, it's the former.
Okay.
We think that Gulak Gear 6, because of product construct, has to be a concentrated portfolio. If, for example, SEBI has talked about doing fractional shares, right? They will allow people to hold fractional shares. If they do that, we would go to the 70 stock portfolio, because we think it's a better investment than holding only 20 stocks.
Got it. Got it. So I think SK had follow-up questions, which you've already answered. One of his questions said, keeping 1 to 2% allocation to stocks in PMS, will it really generate additional alpha? But I think you've already touched upon that.
It does. We can show you historical data and actual performance.
Right. And he's also asking that will long alpha generate more return or Gear 6? So that also we have addressed.
Yes. Over a period long enough, let's say 10 years, we think long alpha will generate better returns than Gear 6.
Got it. Shubham Jain, okay, he's asking if Gulak 6 goes partly or fully into cash. No, we do not really go into cash right now. We're focusing on 100% equity. And Shubham, like Sandeep mentioned, if you should take the risk survey, if you see that you're not an aggressive investor or a moderate investor, you can have either invest in gear 6, gear 5, gear 4, gear 3 based on your risk appetite, or you could go towards gear 6 and have some portion of debt by way of fixed deposits or bonds on the side. Now, take care of, okay. Anuj Rathi is asking, if we invest in STPMS, does it mean that it will take care of the market volatility and only corpus that we need to have separately is emergency fund?
I don't think it is advisable for most people to be 100% in equities. I think for people, well, let me rephrase it. If you are a young investor, I don't know what your life stage is, but if you are, let's say, in your 20s or 30s, and you still have 30 years of work left, 30 plus years of work left, then yes, it is appropriate for you to be all in equities with just some emergency money on the side. I think that would work well. Why? Because you have a long period, and having that extra risk will not hurt you because you're not counting on that money in the short term. As you get closer to retirement and in periods of retirement, your risk tolerance will keep coming down. Now you need that money to spend, and then you would need to have balance between equities and fixed income. But for young investors, it's okay.
So I think
the other aspect, sorry, one more thing, Isha. It's not just stage of life, it's also emotional mindset, emotional makeup. There's some people who will lose sleep. They will be unhappy. They will be looking at their portfolio constantly because emotionally they're not able to handle the risk. So you need to know yourself also. If you are a carefree person, you kind of say, okay, I've studied this enough, all these experts are telling me invest and forget about it, and you're able to do it, you're able to follow that advice, then yes. But if not, if you are going to second guess yourself, get stressed, lose sleep, not worth it. Then only invest as much as you can tolerate the risk. Stock markets, you can lose 50%. There have been years, every 10 years, there is a situation where the markets go down and adjust. Doesn't mean that they're going to stay there, but you have to be emotionally able to handle it.
Got it. I think a follow-up question on this by Ravi Rajput. He fits the customer persona you described, Sandeep. I think he says he's 30 years old, single person having less than 1 lakh expense per year. How would you suggest he deploys the 50 lakhs in equity in the current market situation? So within equity, then how should he really go about choosing different options?
Well, I think you should stay 100% in equities. You're young, you have very low expenses, and you have long journey ahead of you. I think you should invest in the products that you research and that are performing well, as broad as possible. I wouldn't suggest that you try to go narrow. I wouldn't say just invest in technology, just invest in utility, just invest in retail, or just invest in momentum stocks. Don't do that. That is called theme-based investment. You are going after a particular theme, and no theme, no sector, no factor works constantly. All factors, themes, sectors rotate. Sometimes something works, something else works. So you don't want to be spending and chasing returns by theme. What I would suggest you do is you find maybe 2, maybe 3 good products that you like, that you think are able to do best compared to the market, and take your money and split into those. Why? Because you also want to protect against manager risk. There may be some problem with the manager. There may be this is called idiosyncratic risk. So you diversify across stocks, you diversify across managers, you diversify across segments. That would be my advice to you.
So, Sandeep, what would you suggest? Vivek also has given his views on this, but what percentage, if someone is doing 100% equity currently because they are in the early life stage, what percentage should they put in Gulak Gear 6 of their total corpus?
Somewhere between 25 to 50%.
25 to 50. Perfect.
Certainly not 100. That's not a good idea for you. Doing less than 25 is also not a great idea for you, because then you're just increasing the cost and time it's going to take you to understand products, to build the comfort. So the right number is between those two numbers.
Perfect. I think a lot of questions were pertaining to that. Now, another trend I'm seeing, a lot of people are asking questions around the fact that, they are invested in gear 6. Now, one theme is what is the right time to invest additional money in the portfolio? And second is whether people should do an SIP or a lump sum if they have some money right now with them.
Yes. Our recommendation is invest when your savings coming. Keeping asset allocation constant. Whatever your asset allocation is, keep it there, and invest when your savings come in, which means not lump sum, do SIPs and or regular investments. And second is invest in the same kind of ratio in all the investments you have chosen. So some people, their logic is, if this fund is doing very well, I'm going to put more money into this fund. That doesn't make sense. You've got to keep the ratios constant. So if you have picked 3 funds and said, these are going to be my funds for or products for my equity investment, and Gulak 6 has done very well, then actually you should be putting money in the other 2, to be honest, because then your ratio will remain the same. And the reason you picked the 3 was because you thought they all are, kind of good performers. So you need to keep them balanced.
Understood. Interesting. Okay.
Don't chase performance. That's not a good idea. Just because somebody has done very well doesn't mean they will continue to do extremely well month after month.
And what is a good time? This is a personal question that I have. What is a good time to review the products in your portfolio? So if I'm invested in 3 products, one of which is Gulak, after how many months should I review whether the 3 I picked are doing well or whether I should move out from someone?
Yes. I would say equity products should be evaluated maybe once a year. Fixed income can be evaluated more frequently. Again, once a year is good, but you will get good data if there is a problem or something, even on a quarterly basis. So let's say you have a fixed deposit with one bank, and you look at it 1 quarter later and say, oh my God, the fixed deposit rates are so much better at another place. When there are lots of places where you can compare them, then you can move even every month or every quarter. In equities, it's slightly different. Maybe once a year is enough to evaluate and say, is this product the right product for me?
Understood. Because lesser than 1 year could be noise. You might be acting in noise then.
Absolutely. When you make a decision, you should be looking at least 3+ years of data.
Got it.
But every year, that 3-year changes, right? So now you have a new 3-year piece of data.
And I think the ideal, if we have data, we should look at rolling returns.
Absolutely. Rolling returns, and for as long as possible.
Right. And like you mentioned, Sandeep, they should invest as and when the savings or the income comes in. Now, if somebody is getting their bonus, if they have 5 lakh rupees today, so that is also, I think a couple of people have asked this question. I have 5 lakh rupees. Should I do a lump sum right now, or should I break it down into SIPs monthly? What is your take on that?
Sorry, I'm not sure I understood. You're saying that if there is investment, they should do lump sum or break it into installments. I think it's always better to do it in regular intervals. So if that means that you should do it in installments, that's obviously better. But if you have, for example, you've sold a big investment, you sold an apartment or something like that, you're sitting with the money. Instead of keeping all that money in cash and investing at a slow rate, it may be much better for you to, again, look at, this was my real estate investment. It was more of a stable investment. What was my equities allocation? Balance that out. It may be that your risk tolerance is that. So take some part of it, 40-50% of it, put it in fixed deposit, take the other part of it, put it into equities, and do it immediately. There's no need to do that part over time.
Understood. I hope that answers a lot of questions. Now, another theme I'm seeing is people are asking what should be our expectation in terms of returns from Gulak Gear 6. And another question is for how long should we be invested in Gulak Gear 6 to get good returns?
Yes. So, okay, maybe I'll share the screen here. This is the performance. So if you see, the returns over last 3-4 years, Gulak Gear 6 had a tremendous up year in 2020, 60% return in 21, 20% return in 22, and 23 is already above 40%. Now, if you look at this, you would say, oh my God, let's say, 70+%, 60, 40. So maybe the average of these numbers is 40% or something. So that's what my expectation should be. That would be wrong. Your expectation should be index plus some small amount is what Gulak Gear 6 will do. It will outperform index. Of course, that's what we are trying to do. And we have spent a lot of research in getting that done. Index itself, we expect will do about 12%. So maybe the right expectation from something like Gulak Gear 6 should be it will do 15 to 18% kind of a return on long-term basis. Now, in a given year, except 1 year, every year we have done better than that. So, but I don't think that's how over long periods of time your expectation should be set. You will have periods where it will do very well, like it has done, but that's wrong way to expect a equity portfolio to perform over long periods of time.
And is it a good idea to stay invested in Gulak Gear 6 for more than 10 years? I see few people asking the same question.
Absolutely. See, Gulak Gear 6 is adjusting its portfolio every month. So whether you are staying in Gulak 6 or not, you are investing in different ideas every month. So we are helping you identify, and you get the stock recommendations every month. You see the portfolio. It changes every month. We sell about 20% of the portfolio. We buy new 20% of the stock or even more sometimes. And that is keeping it fresh constantly. So from our perspective, you should look at the history and then work with it over, multi-year period to say how is it going to perform. There have been periods of several months where we have underperformed the stock market. So again, recency factor. If you come in and it so happens that over the next few months, Gulak Gear 6 doesn't perform as well as the index, I don't think there would be enough evidence then for you to say, oh, this is not working. That would be recency factor. Your experience recently would make you overweigh that experience relative to what the overall track record and history is. So I would say come in with a mindset that you would evaluate it, let's say once a year, see does it consistently still do well or not, and continue then reviewing it.
Understood. Okay, someone's asking, let's assume market is saturated with inflows and mostly everyone is invested. How does quant strategy still generate alpha?
Yeah, I think there is definitely a supply side issue in valuation. So markets get overvalued or overheated when, for example, fixed income returns globally were very, very low. You had zero interest rate regime in most of the world. So when you have that, equities do get overvalued. Now, when interest rates start going up, equities start getting impacted. This is in aggregate what happens. Within that, there will be companies which will continue to do well, will continue to go up, certainly relatively. And nobody knows whether the interest rate will go up further or will come down from where they are. So even though we know the theory that if the interest rates go up, stock markets go down, but I don't know whether the interest rates from where they are will go up or down. So these things are things that we don't know about. And if you keep investing in good, strong performing equities, then their underlying growth of their profits and all will take care of kind of these adjustment issues on what is going to happen with the supply side. See, the total amount of money in the stock market cannot go above what the stock market is, quote unquote, per se. It's not like if you want to buy a share, somebody has to sell a share to you. You're not buying a share in absolute terms. So the supply of money can increase, but supply of stock is constant.
Yeah, makes complete sense. Now, a couple of more questions about the portfolio. Swayam Chopra is asking, what's the maximum amount suggested to invest in Gear 6?
Maximum amount, maximum would be, my guess would be 50 lakhs, because if you're above 50 lakhs, we would recommend that you invest in PMS. It has the same technology, same algorithms.
Right. Is ST thinking of some discount on Gulak small cases by Shubham Jain?
We do from time to time offer some incentives, particularly for new investors. So stay tuned. I think that the marketing team, Isha, you're probably a better person to answer that. They come up with various offers at different times, especially if you're going onto a new platform or introducing a new product, then we provide those incentives.
Yeah, definitely. So please stay tuned. I think do follow our Instagram page. We do release such updates over there as well. You'll get to know about it soon. Then Ajit is asking, I'm investing in Gear 6. When is the right time to invest additional amount through SIP? Is it just after rebalancing is done? I believe the answer is yes, Sandeep, because closer to rebalanced, right after rebalanced date would be the optimum time.
Yeah, I just wanted to put up the social media links so that people can, they can search for Gulak everywhere.
Right.
But I think what I wanted to do was you can also follow us, or you can follow me or Gulak on LinkedIn, Twitter, Instagram. So that will be good. Now, coming back to the question on what's the timing for additional investment. I'm not 100% sure, but ideal time would be just at the time of rebalance. So if you increase the amount of money just before you rebalance, then I assume that it will build the model with the new amount of money, give you the right positions, and that would be the best, because the signal is at that time the freshest, because it has just been scored. Certainly over the month, the signal it becomes a little stale, and will be different if it were scored at that point. So the best time to invest would be right at the time of rebalance.
Right. Then Neeraj Singh, Neeraj, your question is something that we've catered to in a lot of webinars. You're asking, are stocks selected in Gear 6 on momentum or fundamental basis? So that's our strategy. Maybe we can touch upon a little bit about it, Sandeep, if you'd like.
Yes, I think on our website, there are several webinars talking about this. But in brief, what I can tell you is we have an overall global library of over 400 factors. So they have fundamental factors, momentum factors, dozens and dozens of different types of factors, technical, index participation, money flow. We talked about whether mutual funds are buying or selling this stock. All of those factors are calculated in the library of 400 factors, out of which about 130 factors we have found work well in India. Those 130 factors are scored constantly for India, and then we give weight to specific factors based on two things. One, what type of macroeconomic environment is it? And second, what type of factor has been working recently? So we look at what factors are performing well and what factors performed well when the macroeconomic scenario was the way it is right now. So short answer, it is both fundamental and momentum, and dozens of other factors like value, quality, volatility, technical, index, flows, you name it.
Right. And I think just adding on to this, as to what Sandeep you mentioned, it's very one should not invest in theme-based funds. Why we feel so, because why we have a multi-factor strategy. So we have also done a reel on it to explain with an interesting analogy as to why looking at all the factors is extremely important, which you and I, people who are doing jobs full days, might not be able to do ourselves. So I would just like to, Sandeep, take people through that analogy quickly, which was the elephant and the blind men analogy, where we say that, if there's a very good fable which says that some people were blindfolded and taken close to an elephant. They didn't know what is in front of them. They were all asked to touch different parts of the elephant and to tell what exactly is in front of them. So the person who was standing close to the tail said it's a rope. The person standing next to the elephant's ears said it was a fan. Similarly, the person next to the stomach said it's a wall. So none of these people had actually the big picture. They were limited by the information that was available to them. And that is also what happens a lot of times in the stock markets. If we try to go towards theme-based funds or we try to pick stocks ourselves, we are limited by only that particular theme or limited by the know-how, the skills that we have. Somebody might be good in analytics and they might be looking at just the technicals, whereas somebody who has a finance or a accounting background might be knowing how to look at fundamentals in a better way. Or someone who's not from the finance field, they might be relying on tips of influencers or of their friends or colleagues. So this might not give a big picture and might not help you pick the stocks in a better fashion. So a holistic view is extremely important, and that is what we try to do with the multi-factor portfolio. Like Sandeep mentioned, 130 plus factors that we have identified work well in the Indian markets, and then analyzing stocks across all of those 130 factors is what we do. Just a brief on that. Okay, a couple of other kind of questions. Someone's asking regarding subscription. The current price is 2,900 for 6 months. In future, if the subscription amount increases, will the old investors be paying the same subscription fee? So as of now, based on what happens with Smallcase, since 2,900 is our pricing on Smallcase, if you are on an auto renew model, you will continue to enjoy the benefits of the 2,900 price. But if you are doing a one-time investment or you unsubscribe and try to subscribe afresh later, you would be at the new higher prices. So better to lock in this price and be on the auto renew model to enjoy the same price in the future as well. I see one comment. Sanjog is saying 1% higher, lesser or higher of investment value subscription model instead of monthly fees. I'm not very clear. I think he's saying we should go towards the AUM pricing model. Yeah.
Yes, that is a suggestion that I think we have considered. We have priced it in a way that it's fixed for now, but we have provided a higher AUM option. So one of our gear in Smallcase is called Gulak Wealth, which I think has a minimum investment of 2 lakhs, if I remember correctly. With that, we do offer AUM pricing. Now, that has a bigger portfolio than Gulak Gear 6, not quite as big as the PMS, but that would be the idea. So with PMS, we do have AUM-based pricing. It can work there. But for Gulak Gear 6, we wanted to keep the minimum investment very, very small. and AUM based pricing would not work properly there directly.
Yeah, and just an update here. So Gulak Wealth, we had stopped taking new subscriptions in that portfolio some time back. Also because of this regulatory reason of, we cannot offer AUM based as well as fixed fee pricing to the same client. So we wanted to stick to only one pricing model. And since most of our clients are opting for fixed fee, because it also makes sense at a lower ticket size, like Sandeep mentioned. So we're only sticking to the fixed fee model as of now with the gear 3 to 6. And Gulak Wealth has stopped taking subscriptions. But if you prefer the AUM based model, PMS is something that you can definitely look at. Then, so Sandeep, just a time check. We have a couple
of. By the way, in PMS, we also have different pricing where we offer, more fixed AUM based pricing all the way to more gain share based pricing on whether we are outperforming index or not. So those options are available as a PMS investor. Yeah, go ahead.
Yeah. You have, Sandeep, few more minutes just a time check because there are a couple more questions that are coming in constantly. Can we take more?
Sure. I'm happy to take more.
Okay, perfect. So Neeraj is asking, what is the downside risk in the market fall for Gulak Gear 6?
Look, Gulak Gear 6, the benchmark is the index of NSE 500 or, which is very close to Nifty 50. In a market correction, these indices can fall 20, 30 plus %. So Gulak Gear 6 can also have those kinds of corrections. That is the investment risk of investing in equity portfolios.
Someone's asking growth or value investing in the next 1 year. This question's popping up again and again.
Sure. So that's what we call the theme-based investing, whether momentum would work or value would work. I don't have that chart in my presentation this time. But again, on our website and in many of our webinars, we have talked about it. The momentum strategies work very well, but they have worked about 70%, 60% of the time in the last 10 years. So 6 or 7 years, I think they did better than index, but 4 times they didn't. So we don't believe in any one factor being more important. I can tell you that more recently, momentum has been performing well. Recently in the past, which means right now our portfolio would be geared towards more momentum than value. But we change it every month based on scoring. So don't hold it to say what would happen over 1 year.
Yeah. I see Snoop Dogg with a question. I think that's the username. So he's asking how frequently you review your factors and make changes to improve it.
Yeah, that's a constant process. We have a research team that is looking at factors all the time. Roughly every 3 to 6 months, they would order a magnitude, would have researched maybe another 20, 30 factors. But very, very few make it into the libraries that we use. Most of the time, they would be supplanting something we may have in a particular way that we would now replace with another way of calculating roughly the same calculation. So when a new factor comes in, we look at its correlation to existing factors and its performance relative to existing factors. And we prune or refine our library constantly. So after researching for, almost 15 years, what we feel is there aren't too many new factors that we are adding. We are adding maybe refining the existing factors by trying slightly different ways of calculating those same things, handling corner cases. What happens if this data is extreme or missing or something like that? Those are the types of things that we keep refining on a regular basis.
So someone's comparing it with us with Jim Simons. He's saying if Jim Simons can generate 66% CAGR, then why can't we do the same kind of quant investing? Where is the entry barrier?
Entry barrier is in research. They have a phenomenal research capability. Also, don't forget, they are not long only investors. They have long and short. These products don't have short aspects, so they have the market volatility built into them. Also, they are very diversified. They run several hundred strategies across many, many markets around the globe, and that also brings more stability. You can't achieve that without, a very large corpus. Order of magnitude, you need hundreds of millions of dollars to build multiple strategies, multiple allocations to generate those kinds of returns. If you are investing small amount of money, there is no single bet you can take which will consistently perform at that level.
Makes sense. Sajid is asking, is there a plan to bring a new portfolio which is rebalanced quarterly or semi-annually?
Yes, there is a plan to build a more stable portfolio with lot less churn. We have been researching with something which will rebalance annually and maybe as needed in between. We haven't finalized the specification. So if some of you have comments on what you would like to see, please feel free to put it in the comments. We would love to get your feedback. We did some investor calls and meetings, and we did hear that having a portfolio that churns less would be something that people would appreciate and want. Now, there is always trade-off. If we trade less, the overall return is going to be less. However, for some people, that may be appropriate. They don't want to focus on it every month. They don't want to have to rebalance and do all of that work every month. So we are going to bring something that is less churn, more long-term in our portfolio mix soon.
Bhavesh Patel, I'm new to Smallcase. What is the alpha and beta of Gulak 6? Would we have that data, Sandeep?
I'm not sure if we have that. Let's see if I have it here.
Or we can, in a rebalance update in the next month, we can also have a slide which showcases those metrics. Someone also asked about the maximum drawdown of Gulak portfolio. So maybe these are certain pointers that we can add to our rebalance updates going forward.
Yes. If I remember correctly, I think the drawdown was about 18 or 22%, but I don't want to necessarily quote it. I think we should provide the actual number.
Right.
I do have returns here, months and different periods I can share. It doesn't have exactly the alpha and beta. The beta would be roughly 1 or maybe slightly over 1, but very close. And the alpha is consistently higher than that. If you look at it over last 3-year period, our alpha has been almost 23% over and above the index return. But as I said, that's not a good expectation to set. I think these are exceptional performance numbers, which over long periods of time, are going to necessarily sustain.
Right. I think Sanjog has left a comment saying, thanks for your answers and I'm satisfied. You will have a new investor joining next month. That's great to know, Sanjog. Thank you so much. We feel good that, these webinars and sessions are helping you. And I think, Sandeep, that's about it. We have covered almost all questions that I could look at, and we'll be back soon. So thank you so much, Sandeep. Any parting comments from your side before we close for the day?
No, I think thank you very much. This is wonderful. I'd love all the interaction, and we are making progress. We used to get a lot of questions about specific stocks where people wanted to know what our view was about this particular stock. Should I buy it? Should I sell it? Now it is more about market timing. It's more about those kinds of questions. So we are making progress. We have a certain mindset. It's about systematic, disciplined investing. It's not about tips. It's not about, very specific input. We are actually trying to cater to people who want to spend less time doing investment, not people who want to do a lot more time doing investment. Because I can tell you, we have over 100 team members, and they all have to work quite hard to get to these kinds of products. So to expect that you can kind of do it with weekend reading and some hobby stuff, it's not possible. This is like systematic and disciplined approach is the way to go. So I'm glad that these sessions, the questions themselves are changing, which means we are connecting with the people who are interested in systematic discipline investing, and that's what we want to do.
Yes, sounds great. Thank you so much, Sandeep. I think it was a great discussion, and thanks everyone for joining us on a weekday.